There's a big debate out there. What's better, dividend stocks or growth stocks? Hello everyone, Alex is here. I hope you're well. I hope you're staying safe. We're getting back to normal very soon. I really hope so. I love dividends, don't get me wrong. The majority of my portfolio are also dividend stocks, about like 80 to 90% of those. Those dividends bring me $300 to $500 every single month. And also the dividends are growing on a monthly basis because I reinvest them back once I get them. The other part of my portfolio are things that I like, that I use every single day, and the companies I believe in, mostly tech companies, because that's what it is these days. And the companies like Apple, Airbnb, Coinbase, and all those. And the final part of my portfolio are growth stocks. Not necessarily the companies I'm using on a daily basis, might be, but mostly the companies that I'm looking for. I'm doing my research to find those. I'm seeing their earnings reports and all that to make sure they're good investment vehicles for long term. Very similar type of research I'm doing for my dividend stocks. And apparently you can get a lot more returns from your growth stocks than from dividend stocks. Look at Tesla, for example, last year. That was something. I should have invested. But who knew, right? It all comes down to risk and goals you have. What are the risks you're willing to take for your investments, and what are the goals you have lined up for your life? And today I want to go through a couple of growth stocks I've added to my watch list recently. I haven't invested in them yet, but I think they have a really good potential for a long term, and currently they are in a very good buying state. Let's take a look at them, and I think you might find them very interesting for yourself as well. And the first one is Shopify, the legend of Canadian startup industry. Shopify certainly can be considered a very volatile stock on the short term. Their share price jumps up and down every single day, but what happened with them last year is very different what's happening with them right now. Last year, they gained around 170% throughout the 2020, and this year, they lost actually around 7% since the beginning of the year. And what is interesting, the company keeps outperforming all of their competitors. They keep crushing their earnings report every single quarter. And there is no wonder why it's happening. The company keeps disrupting the way entrepreneurs and small to medium-sized merchants do their businesses. The company's main competitor is Amazon. And certainly Amazon is a way bigger company than Shopify. But the way the Shopify do their business is slightly different. Shopify empowers their merchants to operate and compete efficiently against Amazon. And if merchants succeeds, so does Shopify. And you can get all the evidence to support that from their recent quarter. Their total revenues increased by 110% year over year, and their adjusted net income increased by 957% year over year. This is insane. And the more humanity moves to online to make online purchases, the more and the better Shopify is going to be. So it's definitely a really good long-term opportunity, and right now is probably a really good time to invest into them because they dipped slightly since the beginning of this year. Let's take a look what we have from our metrics for Shopify. Their current market cap is at $163 billion. This is a huge company. They keep growing year over year. They keep reinvesting back into their business in order to innovate and revolutionize the way we shop online. It's been 6 years since the company went public, and since then they grew by 3,800%. Where else you can get that growth? Dogecoin, that's where. Don't invest in that. Their earnings per share are 15.5 and it keeps growing quarter after quarter. Their current share price is around $1,314, which is a lot for a new investor. It's pretty hard to get into this stock right away, but there is a very good alternative to it. There is an ETF XIT, which holds the largest Canadian tech companies, and Shopify is there as well, and it actually accounts for around 24% of their portfolio. And I talked about big growth ETFs in one of my previous videos. You can go check it out there. This ETF will also give you a better diversification into other tech stocks on TSX. I have it in my portfolio and I really like it actually from the growth ETF perspective. Their beta parameter is at 1.43, so it's a pretty volatile stock, as I said before, on the short term, but if you invest for a long term, I think it's almost no risk. And I started to watch Shopify more recently because the world is coming back to its normal-ish state very soon, and I really want to see if they can sustain their performance, their growth once we get to our regular lives and we can shop around not only online but also go to a physical store. Can't wait. And I'll keep you posted if I end up investing in the Shopify, so hit the bell to not miss that. The other growth stock I'm eyeing right now is GoEasy. The ticker symbol is GCY.TO. GoEasy is a Canadian public alternative financial company based in Mississauga, Ontario. It operates in two different segments: Easy Financial, which offers high interest loans, and Easy Home, which sells furniture and other durable goods on a rent-to-own basis. Some say this company is actually a must-have stock in every single investment portfolio. And there are numbers to support that. They've been crushing their earnings report for the last year and a half. This company has been growing super fast, mostly of course because of all this lockdown pandemic situation, but also I think they're lined up pretty nicely going forward as well. And only since the beginning of this year, their stock returned back around 48%, which is pretty good considering we're in transition state to getting back to normal. I believe the reopening of the economy is going to drive their growth even more. This company is also paying dividends, and they've been growing their dividends consistently for the last 7 years. The dividend yield is not very high, it's at 1.83%, but it's been increasing for the last little while, and I think they're lined up to improve that even more. Again, this is a company I haven't invested into yet. I think I'm going to do it very soon, considering what they're doing and what's happening with their business. But I want to still look at what's going to happen with their business once we start to reopen even more, and if they can sustain their growth going forward. And let's take a look what we have here from our metrics. Their market cap is around $2.3 billion, so it's a different company than Shopify, of course. They're very small, considering $2 billion is still a lot of money. But I think they're growing pretty fast, especially in the last 2 years. So this company seems like lined up very nicely for future growth as well. Their earnings per share are at 14.4, which is great. They've been improving that number for last year consistently. Their current dividend yield is at 1.85%, which means that we're not going to be getting only share price appreciation over the long term, but also getting dividends back. Because I consider this stock is actually a growth stock, not a dividend stock, even though they're paying dividends, because I think this company has a very good potential going forward, and I'm really excited to see what's going to happen. Their payout ratio for their dividends is around 13%, so they can sustain their dividend payments for sure. And as you can see, they're probably going to be increasing their dividends going forward as well. They definitely have all the power to do that. Only over the last 2 years, their share price grew by 270%, which is great. They showed they can perform very nicely during this pretty harsh market situations. But what I'm looking here is that if they can sustain that performance going forward as well. Their current share price is $144, and their beta parameter is at 1.64, which is definitely a volatile stock over the short term. So keep that in mind if you're going to be watching this company as I do. So these two stocks, in my opinion, are very hot right now, are very good growth stocks for long-term investing opportunities. And I'm still watching them to make sure I'm right. And I'm probably going to end up investing in both of those very soon. There are also a couple other growth stocks out there that I've been watching recently: Lightspeed POS, Talos International, and Goodfood. About the Goodfood, be careful about it, because they grew like crazy over the last year. And I think mostly due to lockdown situations where people started to order groceries online more and more, and all this prepped food online. But you want to still make sure they can sustain the growth, or at least be at the very similar level going forward. So keep that in mind. See, stocks are not easy, especially growth stocks, the newer companies, because you don't know what's going to happen with them going forward. You don't have that historical sustainability and historical earnings that you can look at. But if you believe in a company and you think they're going to perform well and you see the potential in them in the future and you can hold for long term, that should pay off. With all that, thank you for watching. Don't forget to smash that like button, subscribe to my channel, hit the bell, drop a comment below, let's chat, and stay safe out there. I'll see you around. Cheers, bye.